first one up here, why the S&P 500 is going to be 5,000 in 2024. So looking forward to getting in that one from the BofA Securities head of the U.S. business. Alrighty, let's get into this.
Be a stock picker's paradise with the S&P 500 hitting 5,000 by year end next year, not this year. Joining us right now is Savita Subramanian. She is Bank of America Securities head of U.S. equity and quantitative strategy. And look, there are a lot of people who are now starting to question that, hey, we've run a long way in November. Maybe we're going to see a pullback on some of these things. You think you're pretty convinced that things are going to go up from here?
I mean, not in a straight line. I think there is a high probability of, pullbacks next year around various areas of concern. But I do think that we're in a healthier market setup than we've been in a very long time. So I'm actually feeling pretty good about the market. I mean, if you think about it, it's not even what the Fed, we're not bullish because of what we think the Fed is going to do.
In terms of, you don't expect any pullbacks in rates?
We don't necessarily have a view that's predicated on a big drop in rates. It's really more about what the Fed's already done, which is, the Fed has done a lot of the painful work already, and chances are it's close to over. The market has handled it so far. Sure, there are lagged effects of monetary policy, but if you look at consumers and corporates, I think whenever we say, when we look at things like delinquencies and worry about the fact that they're rising, they're actually just coming back to more normal levels from pre-COVID lows. So I think that we're in...
Before she goes further here, she mentioned about pullbacks in 2024. When do I think a pullback could happen in 2024? And the answer to that is I think a pullback could happen in actually the first quarter. I think we could see, some shakiness in some of the big tech stocks, some of the mega caps in the first quarter at some point in time. I don't know if it's going to be like January, February, or March, but I think there's a high probability we'll see some shakiness during the first quarter. And maybe quite a bit of shakiness, to be honest. I think there's a lot of people that are going to be looking to take some profits, especially if we have a ripper rally in December, which that'll be an interesting video to get into here. But if we have that ripper rally, I think there's a high probability you'll get some pullbacks in Q1.
Where the U.S. consumer and corporates actually look pretty healthy. Consumer confidence might be a little bit rattled by the fact that rates have moved higher, but the bulk of consumers have been able to withstand this pressure. And where we're seeing the pain is more in millennials, which are the prime spending group. But I think even there, the bull case that I don't think gets a lot of airtime is the fact that baby boomers are right at the cusp of this massive wealth transfer. So if you look at the average age of a baby boomer, it's the average lifespan of a human being. Grim statistic. But what that means is that we are at the beginnings of this sort of wealth transfer from, the wealthier generation that's sitting on $80 trillion worth of assets to the more strapped millennial generation.
Wait, they're all going to die and give their money to the youngsters?
Well, okay. So, one way of saying it is,
spending is about to go crazy because millennials never had any money to begin with. So when they get some money, man, it's gonna be spending like crazy.
I mean, we're at that point where that wealth transfer begins. But then on top of that, I think
avocado toast sales and cold brew sales are going to go through the moon. Holy
the idea
smokes.
that baby boomers are even spending more on services and goods than they used to. So it's not just baby boomers are taking over all the wealth and they're never going to spend again. I think that there are cross currents that are actually pretty bullish for consumption. So in the U.S., I think that U.S. consumers are actually in a pretty good position.
We have never seen the Fed raise rates by 500 basis points and have it not result in some pretty severe dislocations. Why do you think this is different?
Yeah, the baby boomer generation, let's call it reaching retirement age, has been reaching retirement age. That bodes very well for a few specific stocks come to mind that it bodes very well for. And, one group of those stocks is travel, right? Travel. We do know a lot of people when they retire, they love to go traveling, and they travel and they travel and travel until, you get to a state where your body can't do it anymore or something like that, and you're like really elderly. But up until that time, people want to travel and travel and travel, see the world, see different places, go different places, experience different things that they weren't able to do when they were in their working years, right? And so Cruise lines benefit huge. So, cruise lines, Carnival Cruise Line, Royal Caribbean, all those guys will benefit huge over this next, I would say, 10 to 20 years. It's not like it's a 1-2 year thing. It's like this is the next 10 to 20 years. They're going to benefit huge. I think a lot of resort companies are going to benefit big over this next 10 to 20 years. And so that's just a little food for thought in regards to that.
So I think this time is different for a number of reasons. One is that we were at almost too accommodative rates at the beginning. We were at 0, and going from 0 to 5 is different from going from 3 to 8. So I think the fact that we were going from super ultra too accommodative to more normal is one facet of this. I think also on top of that, you had consumers and corporates preparing for a rising interest rate environment, and in fact they locked in long-dated fixed-rate debt obligations at very low interest rates, and I think that's serving them well now. I'm not saying it's going to be gravy from here, but I do think that the one kind of positive where we are today versus where we were a couple of years ago is we know how the Fed is going to get off of ground zero in terms of interest rates. We're already past that point. We've seen massive inflation volatility, and inflation volatility, we know inflation isn't going to be 0. It's not going to be 10, but it's going to be somewhere in between that range. And on top of all of this, we also have an environment where U.S. companies have begun that process of moving IP tech, equipment out of China and less friendly regions of the world back to the U.S. So I almost feel like a lot of the work is behind us rather than ahead of us, and now we can kind of get a better grasp on what earnings are going to look like.
We were 4,800 in 2021.
We were.
So your big bull.
That's a good point, right? When you look at it from that angle, it's like, okay, S&P 500, 5,000 at some point in 2024. Well, that's still almost flat versus where we were at in 2021. Right? Because 2021, we were 4,800 plus. So when you look at it from that angle, it's like, dang, that doesn't seem that crazy at all, right? Looking at the S&P 500 today, that's like, wow, that's a pretty big upward move for next year, right?
Case gets us to 5,000 by the end of 2024. So 3 years later, we have a total S&P return of
not that much.
3 or 4%.
Exactly.
That's not, that's not a very crazy call.
It's not a crazy call.
But it's only 10% next year.
It's 10% returns next year.
We could do 20. Couldn't we do 20?
Above average. I mean, I think we could do 20. It depends on the shape of the consumer. It depends on confidence. But I think the idea is we're one of the higher forecasts on Wall Street.
That's a good freaking point. And if you want to be bullish on this market, I think that's a very important thing. I think that's very important, right? Because the bottom line is, even if we go to 5,000 by the end of 2024, that is horrible 3-year performance. I mean, absolute trash. The fact that the S&P 500 only went up a few percent in 3 years is really bad, right? So, yeah, I mean, this is one of those things you hear it and it's like, dang, that's not even that crazy.
Not that aggressive. I think most strategists are quite bearish at this point.
That's a really
conservatively allocated.
Most people have not experienced what you're looking at right there since 1980. It's been almost straight up since 1982, basically. I mean, this has been, what would you call that? A secular trading range? I guess it's really kind of a secular...
it's a big fat trading range. But I think, and maybe we stay in it.
So Deutsche Bank's at 5,100, BMO 5,100, RBC 5,000, Bank of America's at 5,000.
It's not over.
Yeah.
Which basically means that Wall Street is really starting to flip over to the bullish side.
It's 10 years, which would be the scarier.
Could be. It could be you have to start with 2.
I don't think it's going to be a trading range for the next 10 years. I'm bullish on equities for the next 10 years.
$34 trillion in debt.
Okay, that's government debt.
It's possible. I mean, it's possible we could be range bound for a decade. And let me explain exactly how that happens, okay? So let's say next year is good for the market, okay? Let's say 2025 is good for the market. And then let's say the Fed lags really start to catch up with us heavy. End of 2025, 2026. And let's say we actually get the big recession everybody's been calling for the last several years. Doesn't happen next year. It doesn't happen in 25. Let's say it finally happens in 26. Okay. And let's say it's a big one. Big, nasty one. Similar to the great financial crisis, right? So let's say going into that recession, S&P 500's at 5,700. Okay. Let's just throw that out there. 5,700, 2026, the big recession happens. Next thing you know, S&P 500, gets nailed. All the stock market indexes go. S&P 500 goes from 5,700 down to 3,000, right? Which would be actually less of a drop than the Great Financial Crisis. Keep in mind, the Great Financial Crisis, peak to trough, was over 50%. So next thing you know, we're at 3,000 in, let's say, 2027. Okay, so now we got to climb back from 3,000. So Fed drops rates to nothing, quantitative easing, all the stuff, right? Economy improves 2028, 2029. Next thing you know is 2030, and the S&P 500 is 5,000. That's how it happens, folks. That's how it happens. That's how you end up having kind of a lost decade, which is what we had actually in 2000 through 2009. We had a lost decade in there, 2010. And it happened because you had that big market crash. So I will not be here to say, it's not going to be a lost decade. There's potential like 2020 through 2030 is a lost decade. You need a big recession in there, though. I mean, a big one. Not like, little baby recession. You need a heavy recession at some point to screw everything up, tank the market, and then you have to work back up coming from that. Okay, so anyways, that's how you get there. That's how you get there, right? And it's possible at some point in this decade we have that, right? It could be a year, 2 years, 3 years, 4 years. It could be at some point, right?
Right. And government debt is not anathema for U.S. stocks. Even if we're an emerging economy now and, we're going to be downgraded.
Higher interest rates could be anathema and that's what results from the $34 trillion in debt.
But the higher interest rates, what's interesting is that the higher interest rates are going to hit a lot of pockets of the economy, not necessarily public equities, because public equities have been marked for this environment. What I worry more about is all the stuff sloshing around in private equity, private credit, the shadow lending machine that's been taking place for the last 10, 15 years. But public equity right now is marked to exactly what's happened. And that is a high interest rate environment. We all know what refinancing risks are going to look like. Unless rates double from here.
But I can connect some dots for you between when the government owes that much, they have no money to spend it on anything else that they want to spend it on. And you know what they do? They don't spend less. They try to take more in. So they're going to raise taxes. They're going to raise taxes on corporations. They're going to raise taxes on individuals. None of that is good for stocks.
I don't necessarily see that happening in the near term. I think that one of the ways the government has been able to navigate high deficits is by outgrowing that deficit. And I think that the U.S. economy is actually at a good point at which we could see tremendous surprises in GDP growth going forward. Think about it. We're at a point where we have had underspend on manufacturing. We have the best technology.
Maybe AI.
AI could be part of this productivity boom. We haven't really seen a productivity boom in a very long time. We've mostly seen earnings from cheap capital globalization. Now we're at a point where we could actually see productivity kick in, efficiency gains.
True, 100%. She's like, you kicking me off the air, man? It's like the Grammys when they start playing the music. Good point, Sarah. Okay, next one up here, Gene Munster. Expect a shift in performance from the Magnificent Seven to mid-sized tech. This should be interesting. Okay.
Deepwater Asset Management managing partner. The Nasdaq's up a lot this month. We were just shocked to hear double digits, Gene. So I don't know what that means. Before we talk about the ones you do like, since it's such a popular issue, the Magnificent Seven. Is it too late? Would you buy any of them at this point?
I would, Joe. I think that still you put Google, Meta, Deepwater owns both of those, Apple in that camp. That is a select group, so you don't need to own all of the Magnificent Seven, but I think you should have some exposure. And generally, I think about a tech portfolio as we orient our tech portfolio. We think about a quarter of it is in some of these bigger companies, but there has been a shift and a belief that we have that even though these Magnificent Seven will continue to be steady, continue to be part of most people's and should be part of most people's portfolio, we think performance is going to come from the sub $50 billion market cap companies. These are companies that have been largely forgotten, and I think that we have seen a positive shift in terms of investor and their appetite for this. The Magnificent Seven is up 0.4% over the past week. The NASDAQ up 0.5. That's rare, just given the weightings to see the MAGs.
Yeah, I could definitely see that happening. That's what I call rotation, right? And when rotation happens and you think about it from the big dogs to some of these smaller guys, it's not just about going to small cap stocks, the under $5 billion club. It's like Gene Munster's saying here, it's like the under $50 billion club.
Then underperform the NASDAQ, albeit fractionally. But more impressive was this sub $50 billion group. And we went back and picked 7 of what were some of the high flyers back in 2021 as kind of a benchmark for what these high growth companies are, these smaller companies. And they're up 3.5% in the past week. And so this is a shift in terms of sentiment. The reason, of course, is that more steady interest rates, just keeping them where they're at, gives investors a little bit of an opportunity to step back and think about owning a broader mix of tech beyond the Mag 7. And so I see this as a real encouraging data point.
There's 2 stocks that come to mind when I think about this rotation of money into the more mid-sized tech. 2 stocks specific. You want to know what those stocks are? Zoom, Palantir. Zoom and Palantir are the first 2 stocks that came to my mind when I thought about mid-sized tech. The under $50 billion club, and money rotating to them. And Gene Munster even brings up stocks that were hot years ago and things like that. Which, by the way, Palantir's been red hot this year. Yeah.
Is that as I checked my feed this morning, you just we kind of think about what's happening with Cyber Monday. The one piece I would caution related to this, again, I'm very bullish on these smaller ones. But what we saw,
PayPal's almost there. I mean, PayPal's been trading $50-60 billion market cap recently. So, I mean, PayPal's almost in that mid-sized tech area.
Cyber Monday up 8% or 9% year over year. The consumer still is really strong. And so I think that some of these concerns about interest rates and what they're doing is going to linger. But I think on the margin, 2024 is going to be a year where we're going to see a shift in performance from the Mag 7 to some of these smaller, we'll call it smaller, sub $50 billion market cap companies.
So how many of those, there must be a lot of them. How many have you looked at? How many are there? And I don't know how many you're recommending. And the ones you look back, just to test your theory that you look back in 2021, there was no AI back then. Aren't they different? Aren't there some different opportunities now? Aren't there some different names that wouldn't have been as attractive a couple of years ago? So how many are you looking at, and which ones you think we should buy?
Okay, so our short list, we'll call it our watch list, is about 100 different tech companies.
Oh my gosh! And
we own about 20 of those. So just to give you a sense about what the scope is. In terms of those 7, is most of them none of them had an AI bid 2 years ago. And that's what I thought was appropriate, was to, really take those companies that didn't have the AI bid and look at how they've performed more recently. If we would have selected companies that had more of an AI flavor to them, they would have been up more. And then to answer your other questions, what are those companies that we're excited about? They're companies that probably a lot of people haven't heard of. CrowdStrike, for example, is a $50 billion market cap.
They report today, I think.
Cybersecurity company, but that's one that we're optimistic about. One company that, another one a lot of people have heard of, obviously, is Etsy. I think what's going on in retail, that stock has rebounded nicely. It's up about 23% in the past month, but that continues to be an opportunity relative to just still an $8 billion market cap. That can be a much bigger company. And so that's the general lines that we're looking at, is companies that will grow faster for longer is our mandate.
All right, so that's 2. You got the universe.
He wants them all.
And you've got 20 that you own. What else?
He wants more.
Other companies, think about Zillow, for example, and what they're doing in terms of kind of changing how we're doing real estate. Their next version of their app, I think, is going to bring in more metadata. I think they will have an opportunity. Palantir is another company that we own that has an AI bid to it. Palantir. So, they've obviously done a lot. And then we're also investing, when I think about that list too, we do invest in both private and public companies. And so on the private side, there's Redwood Materials. This was founded by J.B. Strobel, one of the founders of Tesla, their battery component manufacturing company. And then Anduril, which does defense.
Palantir's having a good day, by the way. I think Palantir's my best stock today. It's up way more than that now. I'm trying to think, how much is Palantir up now? Let's take a peek here. I think I saw it up 3+% earlier. I'm like, isn't it my best stock today? No, PayPal overtook it. PayPal the best? Let's freaking go, PayPal. That's what I'm talking about, baby. Palantir is now my third best stock. Earlier today, it was my best stock. It was up 3-point-something% earlier today. Look at PayPal. PayPal said, give me that. I want the reward for the top stock here today, man. That's what I'm talking about.
Tech. And so our portfolio is comprised of both public and private. It's a hybrid fund. So those would be 5 companies that we're excited about.
You mentioned Tesla, but you didn't mention it when you were talking about the Magnificent Seven. What do you got, like a hold on that?
Yeah, I think Tesla's one that's going to continue to do well. I think what we're going to see with Cybertruck here is it's going to be announced the handoff event, the delivery events on Thursday afternoon. And I think that's really going to stoke investor optimism around this. So I am optimistic on Tesla. The reason why I don't mention it as one of those 5 is because I don't see it having a 2 or 3x upside opportunity over the next year. And that's the kind of goal that we're shooting for, these companies that have more significant upside. But I just want to quickly focus in on Tesla because I think that this is an important week for the company. Cybertruck, I want to caution, isn't going to have a big impact to numbers over the next few years. It's going to take time for them to ramp up manufacturing. But I think from an expansion to multiple perspective, I think this is going to be an important event. They're now showing the Cybertruck at 15 Tesla retail stores, and people are lining up to see this car.
Oh, yeah.
This is exactly what we saw when they originally were showing off the Model 3. And I think that investors largely did not appreciate this pent-up demand piece are not appreciating this. And so I think that to answer your question specific to Tesla, I think that the stock is going to move higher in the next week as we start to see Cybertrucks in the real world. And investors are reminded that Tesla is doing something, is being more aggressive in terms of how they're pursuing the future relative to other car makers.
You don't think that any of the other Magnificent Seven that you like are going to be 2x or 3x? You're talking about the sub 50 billion or
right.
The 2x and 3x. Okay.
We orient our portfolio to be more focused on some of these sub 50
right.
$50 billion.
I meant the law of large numbers. None of the Magnificent Seven are going to be 2x or 3x.
That is correct. But we don't want to be all Mag 7 for our portfolio. And so we just limit the number that we can have.
There's one big tech stock that I think could still do another 2x in the next 12 to 18 months. You know what stock it is? Meta. I'm not banking on this, certainly, but if I was to say one stock to 2x in the next 12 to 18 months, it's Meta. And the reason being is it's so undervalued still. And on top of that, I think they're going to destroy all these analysts' expectations. So it's already very undervalued if you look at it on a valuation basis based upon what analysts have the company earning over this next year. I think they're going to blow those numbers out of the water, quarter after quarter after quarter. So I think analysts are going to have to keep bringing up their numbers. I think they're going to have to keep raising price targets on Meta over this next year. So if you forced me to pick one of the big dogs that has a real chance to 2x in the next year and a half, that's the one I would actually go with. Alrighty, next up here, Brian Belsky made some big moves in his portfolio. Let's react to this one.
The day, and he gave you his macro view, but he's actually rebalanced his book, and he has a number of new buys and sells. So, Brian, let's go through these. Good to see you, and thanks for coming back on to share these with our viewers. In terms of your large cap disciplined value fund, you bought Boston Properties, Disney, Fifth Third, Goldman, Merck, Qualcomm, Regions, U.S. Bancorp. I think it's very interesting that you bought a bunch of regional banks, which were the center of the storm some 6 months ago, but here we are. Tell me about those first, the regional bank moves that you made getting in to those.
Well, thanks so much for having us, and you're being very righteous and nice to Steve today. It's a tough day for him. We were funding some of this by selling Netflix. We bought Netflix in June of last year as an opportunistic value call of 2022. I'm sorry, it's up 171%. So we're funding some of that. And as you know, we've been big bank believers for a long time. And we just want to diversify out a little bit, especially given the fact that if you take a look at price correlations and valuations and yields, Bank of America, Berkshire, and the brokerages look very good. And JP Morgan, we're using some JP Morgan to fund some of this. And I also think, too, of our theme of everything in moderation, own a little bit of everything, it's time to start looking at some of these regional banks that we think are very well positioned over the next few years.
Yeah, I don't know how much I agree with selling Netflix to put in, let's say, a JP Morgan, because the issue is with somebody like a JP Morgan, the longer rates stay in an elevated place, the longer you can get good money, good returns on treasuries, good returns certainly on savings accounts, I think it puts more and more pressure on JP Morgan for assets to potentially leave JP Morgan, right? The longer you can get 4% plus from a savings account other places, I think the more likely people are to move money to other financial institutions, whether that be the Marcus product from Goldman Sachs or whether it be from Ally Bank or SoFi or whoever. And so I think that puts JP Morgan at a risk because JP Morgan is still not paying crap on their savings accounts. Like it's a joke in terms of what they're paying out. So I think the longer rates stay up here, I think the more and more likely it is that a company like JP Morgan either has to start actually paying good returns on CD accounts, on savings accounts, or they're going to potentially lose more and more folks over to other, financial institutions. Like, I'm somebody that banks with JP Morgan. I'm just like, why do I want to keep that much money on Chase when I can go get good returns somewhere else with that money, right? And make potentially hundreds of dollars a month or even thousands of dollars a month in interest versus keeping it on Chase. So I think, that's something that needs to be considered out there.
So aside from that, the buying Goldman, buying Citi, and selling JP Morgan, what's the thought process?
He's selling JP Morgan?
Behind that?
I thought he was buying it.
Okay, so if you take a look at, let's just talk about...
What it sounded like to me is he was selling Netflix to buy JP Morgan. That's what he was saying.
And the correlations and how JP Morgan trades relative to Bank of America in Berkshire, we're already covered there. And Citigroup, from a value perspective, the cheapest stock on a PE basis, almost a 5% dividend yield. I love what Jane Fraser's doing over there in terms of reorganization. You want to buy a big bank like that when they're cutting costs. They brought in great management like Andy Sieg from Merrill Lynch and Bank of America. I really, really like that play. And I really think it's a contrarian bank. If you talk to a lot of the big institutions,
one of the things I'll say about the financials, and this reminds me of... I've been talking about the time period we've gone through over the last few years. I've described it as it could be we're in a 2002, 2003 type time frame over this last couple of years, right? In terms of when you came down from the tech bubble and the stocks crashed and then you bottomed out the market, right? Well, coming out over the next few years, coming out of that, 04, 05, 06, like the financials had a great run. Real estate obviously did tremendously well. It actually created a pretty big bubble that obviously needed to be popped, but banking did very well. So maybe we're going to go into a next few years here where banking is maybe the outperformer of the bunch, right? Before we get ready for 2007, 2008 in a few years from now, right? So I don't know. That's something I've kind of considered that, the last few years kind of reminds me a little bit of that 02, 03 into 04 type time frame.
From that, and they've invested in Jamie, and Jamie has done a wonderful job. It's up 16% this year. Citigroup's still down, or it's actually just up 2%. So, you want to be able to go where I think the opportunity is going forward, and we're already covered in the really big money center banks like, let's call it Bank of America and Berkshire.
And why'd you buy Disney?
And by the way, Goldman Sachs, I think that's an interesting buy. And the reason being is, let's assume the market continues to roll on and, we get a lot of strength in the market over this next 6 to 9 months. I think you'll likely start to see IPOs come to market in 2024, the back half of 2024 specific, which obviously bodes very well for somebody, in the investment banking space or somebody like a Goldman Sachs, right?
Well, we've been on the network and talking about Disney. We were really early in our tactical portfolio by buying Disney. I still think Bob is going to get this thing right. He's going to create some sort of a scarcity proposal for Disney. He's already talked about cutting content and cutting the Marvel films. Only one is coming out next year. So I think I like management teams. I was a little early buying Disney in my tactical portfolio. But I think in communication services, as we want to play more of a bar with respect to the...
So I don't think Disney's necessarily a bad buy, but Disney has a lot of problems. They're still working through those problems. Now they're part of the cancel trade because Elon Musk called them out in his big interview. And so I hear that supposedly thousands of people are canceling their Disney Plus packages or whatever. Oh my gosh. People are going to realize they're going to need to cancel every company. Like I'm just like, it's ridiculous at this point in time. But, it is what it is. But anyways, Disney not a bad buy, but they still got a lot of mess to clean up over this next. I would say it's going to last another 1 to 2 years in terms of the mess cleanup and right sizing the company and getting everything in the right direction. So, Bob's still got his work to do, his work cut out for
like
him.
Netflix and Google, and on the other side, some of the traditional telecom stocks like AT&T and Verizon. We think Disney's in a sweet spot. So I'm probably a little bit contrarian here, but I believe in Bob Iger.
Some of the other moves that I think are interesting here. So you bought Qualcomm, you sold Cisco. I want you to tell us why, and then I want Jimmy to comment on that.
Well, I think Cisco may be over its skis a little bit on the cybersecurity side of things. They may have overpaid, and I think the stock has slipped a little bit. Cisco is a great value name within the technology sector. I think Qualcomm's a little bit better value. Plus, what we're doing in our overall semiconductor position, Scott, for 2024 is, we're going to remain kind of core positions in Apple and Microsoft. I think with NVIDIA and AMD, what we're trying to do is play more of a barbell. So for every AMD position, we want to match it up with a Qualcomm, and for every NVIDIA position, we want to match it up with a Broadcom. That's why we added Qualcomm.
I like that guy. I like that guy. I think he does probably pretty good run on his portfolio. I like him. I can't say that for everybody I always see on here. But that guy, I actually like him, and I like to hear kind of his perspective on what he's up to with his portfolio and things like that. Okay.